Welcome, everybody, to the Q1 2023 Jacksonville Real Estate Market Update, special edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen, co-founder of JWB Real Estate Capital. For those of us joining us, since this is the big one, say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
And part of the Not Your Average Investor Show team here is our community manager. We call her MTM because she brings us the moments that matter, and because we also call her Madison the Magnificent. Say hello, Madison.
Hi, everybody.
We've taken some feedback from everybody. We know that this is our most attended show. We know that what you're coming for is the insider juice Jacksonville info. So we're going to front load it. So if you're just joining us for the first time, love having you here. If you are watching live on the YouTube stream, love having you. The best thing that you can do, which most likely all of you that are joining today have done, is go to nyais.com, register. It goes on your calendar. You're going to get invites to different things that are happening in the market, things that we're seeing, special insights from old GC's genius brain over here, and entertainment from me most of the time. But more than anything, people join us for what, GC?
The roll call, baby.
Roll call. We got a lively community in the house. Madison's already welcoming everybody. We got Lee, the MVP Bishop, checking in with a good morning, everybody. We got our leadoff hitter, usual leadoff hitter,
John Henning,
checking in with a good afternoon. We got Nadeem Shah, our good friend from the West Coast, with a good morning, good afternoon. JWB family, all is doing well. We got the ringmaster,
Andrew Barnhill,
checking in. Good day, everybody. We got Christopher Lee from Fernandina Beach checking in. Good to have you back, Chris. We got the fairy godmother of the Not Your Average Industrial community.
None other than Miss Jen Filson.
Miss Jen Filson from the beautiful Monterey, California. We got the touchdown maker,
Shannon Baker in
the house. We got Greg number one,
the better Greg,
Greg Stone in the house from New Jersey. We got our friend Keitha Janella from San Diego, who we got to meet at the IRL meetup. Keitha, good to have you back. We got Jane Terracano. We call her Mama Jane around here.
Mama Jane, my business partner's mom, kind of like my second mom.
Yeah, like the seed investor. We got Maddie Rigger in the house. I think that's a new name.
Well, Maddie's on our team, it might be the first time she checked in on the chat. So way to go, Maddie.
Yeah, good to have you here, Maddie. We got Pedro Nacianceno checking in from Jersey in the house. Pedro, good to have you back as well. We got Deborah Schwartz, my karaoke witness. Deborah Schwartz.
Karaoke witness. I love that. I think that sticks.
Say good morning, everybody from the West Coast. We got our favorite name to pronounce, Aaron O'Neill, into the lights. Love when Aaron O'Neill checks in. We got Mike McLeod.
Mike McLeod.
Mike
Wow.
McLeod.
Long time. No talk, Mike. Like Mike is a longtime client of JWB. Super happy to have you here.
I like it that you're here, Mike. Good to have you. We got Chris Gonzaga from the illustrious
Hudson Valley.
Good to have you in here, Chris. We got Caitlin Kitchens checking in. Good to have you, Caitlin.
Another JWB teammate.
Yeah, teammate. We got the early bird.
Dean Curry.
Checking in.
Right.
We got the mountain man.
Billy Green.
From the mountains of Colorado. We got Papa Jay in the house.
All right. What's up, Pops?
Jay Cohen, the original investor. Him and Mama Jane are the original investors.
Yeah.
Right? Yeah. We got the first family of the Not Your Average Investor community, Ken and Carolyn Milene, patriarch and matriarch.
We salute you.
Good to have you in the house. Who else we got in here? This is a nice long.
This might be a long one. Look at this. So almost
Pop is back.
All right, Pop.
Chris Shapiro in the house. Good to have you. One of the OGs of the Not Your Average Investor show. Always good to have him on. We got Tim Hoving. That's a new name for me.
That's
investor. He's an investor.
All right. Congratulations, Tim. Thanks for being here.
Yeah. Let us know what brought you. Glenn Friedman, a local Jackson investor here. Glenn, good to have you on board as well.
Glenn, great to see you.
Karen Tallman.
JWB teammate, of course.
The teammates are in the house. Guillermo Mendoza from New Jersey. Guillermo, welcome to the show.
All right. Is that a new name?
Yeah, that's a new name.
Welcome to the party.
Guillermo is my best friend's name, Guillermo Younger from Honduras. So I love that name for the record. The second family of the Not Your Average Investor show, Gary and Rosalind Riley from Marietta, California.
We don't really know what to do with
we
that.
salute you as well. I don't know. All right. Tanner's in the house. Marie Rockoff from Arizona. Taylor Stone from Long Beach, California. That's a new name.
I think so.
Right?
Welcome to the party.
I love Long Beach. Helen Duque.
JWB teammates representing. Thank you guys for being here.
Eddie Harris from Hotlanta. Max Needle, another teammate. Laura Colby. Good morning, everybody from Washington State, a current investor. Chadwick Sorensen, investor, first-time listener. Good to have you, Chadwick. This is awesome.
You know what? I think this might be the first time in a long time we've had over 100 folks here. You know what? Pablo challenged me if we ever get to 500 folks, He said that I have to do like a special dance on video. So, this is a big stepping stone. Appreciate all of you for being here.
Yeah. Yeah. Just so you know, if we can get this thing to 500, we're going to do that thing that TikTok dance where I'm driving and Greg does the it's Friday night.
I love that one. That's right. I'll work on my moves.
We're doing that. All right. I want to call out everybody's name here. Chris Smith, Sergio Prieto, go Gators. Bob Wiesner, our good friend. Who else? Who am I missing? S. Minakovic from Cape Coral. Good to have you. Walt Hart in the house. All right. We got a full house. I think we're all here for one reason, GC. Or I guess there's a couple different reasons for why people come. They are investors that have their money with JWB that want to make sure that their asset is doing well and is going to continue to do well. There are people that are curious about whether or not they should be investing in Jacksonville real estate with JWB or elsewhere. They're looking at how is Jacksonville going to perform over the next 5, 10, 15 years?
Sure.
And then there is the local investors, right? Like that understand that JWB is kind of like the 800-pound gorilla of one of the 800-pound gorillas here in Jacksonville. And they keep an eye out. They know that you got proprietary data. They know that you have a 5,000 property data flywheel that we talked about. And if I put myself in those shoes, right? I am the voice of the investor. I am an investor. And I think to myself, the headlines over the last year have been brutal, right? Like we're hearing it's all about this like recession that's been looming. It's over the last year, the stock market's taken a beating with a couple signs of life and then another pounding. The Fed is going willy-nilly, doing stuff with interest rates that we haven't seen in more than one generation. And now add to the mix something that you predicted. Now there's all these like national headlines talking about real estate crisis and real estate losing value. You can find one in the Wall Street Journal, throw a dart and you hit a headline like this. So people are coming here to find out what is going on in the real estate world, what is going on in Jacksonville. How would you answer that question?
Well, I just think that there is a lot of noise out there right now. And I think this is an important time to understand your sources of data, to understand data and to understand perspective as well. I think something we've said a number of times on the show is that, having good data is not enough when it comes to understanding where you're going to put your money. You need data with perspective, because data without perspective is dangerous. And I think we are seeing a lot of data out there thrown around without perspective, and especially when it comes to real estate. And unfortunately, I think it's really hurting people. It is creating certain narratives out there that if you have been investing for a full market cycle like we have, you start to understand that data differently. You make different decisions. You're more confident because you understand not just what that data point is, but what does it mean? And then what does all of this mean compared to your other investment alternatives? I think one of the big concerns right now is that people are so scared from an investment standpoint, right? The stock market is certainly not giving people peace and quiet. And there's a lot of sleepless nights there. Bonds are not keeping up with inflation. And then they start to read about real estate and these negative narratives. And they start to say, well, what should I do with my money? And then in their head, what they say is, maybe I should just keep that under my mattress. Maybe I'm just going to take myself out of the game on this one. Yep. And unfortunately, that's not a good idea. If you want to, of course, get ahead, you have to learn how to invest and to do it in a risk mitigated fashion. But definitely right now, it's even more painful when you've got inflation still super high. So, I think this is a time to separate the noise from the truth, right? A time to lean into data with perspective. And so as I was preparing ahead of time for this call today, that's really what I wanted to do is to kind of go down some of those, call it negative narratives that we're hearing about real estate, maybe even about Jacksonville negative narratives that we're hearing, and then provide that data with that perspective so that we can, equip all of you with the truth.
All right. We're going to do some different data to give you a sense of direction of what's happening out here. One of the big things that you have taught me, GC, is that there is no national real estate market, right? This is not like the stock market where it's just happening and everything affects each other. It's much more segmented and it's much more specific to the market. So that's where we're going to start today, right? Like this is where I think JWB really has a ton of value. It's your insight into the market of Jacksonville proper. So Why don't you start us off with one of your favorite charts here, Jason?
Absolutely. And the great thing, if this is your first time joining us for the Jacksonville real estate market update, I hope you keep coming back. What you'll see is that I show this data every single time. It's the same chart. We just update it with the most recent data. And I think sort of benchmarking, again, gives people just a little bit more understanding, that perspective that we're talking about. So this is not a new chart for all of you not your average investor fans out there. You've seen this over and over and over again. And what we're seeing here is the blue line is all of the median home sales prices in Jacksonville going all the way back to 2001. And then that red smooth line is the projected median price, which is the long-term historical average of home price appreciation for Jacksonville. And so we're starting to, by using this chart, we're able to see what is pricing doing today versus what it should be doing if home values continue to grow at their historical rate. And so you start to see, if you go back from 2001 to 2008, you start to see that big run up. And when people talk about, call it a bubble, right? That's what they're talking about. Prices ran up way faster than would have been projected. And then when you're seeing the crash, you see that go below that median projected line. And then subsequently, you've seen that above average home price appreciation as we're getting now into 2023. But Pablo, what do you see here for the data? What's the data showing about home prices here, call it over the last, 6-8 months or so?
It looks like it reached a peak here at some point, and now it seems to be kind of dipping.
Goodness. What do we see here? Is this the next 2008 in your opinion? How would you know?
I listen to you often, and we run together on Tuesdays and Thursdays. I think
you have a little bit of insider knowledge.
Yeah.
But if you are a media type, if your job is to write articles that are going to attract eyeballs and clicks, what do you think you're writing about when you see a graph like that?
It looks like home prices are taking a dip.
Oh my goodness. And if you know that people are super emotional and fearful about 2008 and all of the pain that caused economically to our family structures as people lost their homes, do you think that might get some clicks?
Oh yeah, definitely. Negative headlines drive way more clicks than positive ones.
Absolutely.
Yeah.
Well, this is where we need to sprinkle on a little bit of context, a little bit of perspective. Because again, if you've been joining the show, I talked a lot about how home prices are going to go down in the second half of the year in 2022. And guess what? That's what we're seeing. Home prices are going down in 2022. But what I also said is that this does not mean that there's a crash coming, because what you're going to see, and as we start to kind of go to that next slide there, Pobs, you're going to start to see that this decline happens every single year, right? All of those declines there are very similar to the decline that we're talking about over, call it the last 6-8 months, right? It happens every single year, and it goes by a certain name. It starts with an S, Pob. What's it called?
Seasonality.
Yeah. Killed it, bud. Killed it.
Thanks.
There we go.
I'm trying to, just so everybody knows, I'm trying to remove this gray box that's on the bottom right. In the meantime, just listen to Gregg's voice. It's not blocking anything. That's really important. There's no data on the screen.
No gray box can hold me back here when I'm talking about seasonality here, right? So seasonality happens every year. And this perspective that we all need to have. I wish every newspaper had it. I wish every article writer had it. Unfortunately, they don't, but you need to have it because it's going to inform you. Seasonality happens every single year. So I put some of the stats together. I went back to look from 2001 to 2021, and I looked at home prices. And home prices from June to January declined on average 8.1% from June to the following January. Declined 8% on average, okay? In 19 out of the 22 years, home prices declined from June to the following January, 19 out of 22 years.
And, correct me if I'm wrong, but 2001 to 2021 has been a pretty good run for Jacksonville property, right?
Exactly.
Yeah.
So knowing that home prices from June to January declined 8.1%, and almost every single year they declined something, home prices overall from 2001 to 2021 appreciated 7.9% on average.
Okay, so almost 8%.
Yeah. So if you go from June to January, call that half the year, and it went down 8% on average, but overall, you're up 7.9%. What does that mean for the other half of the year?
likely that it went up more than 7.9%.
Yeah, they had to go way up,
Mm-hmm.
right? They had to go way up to counteract the decline, which happens every single year from June to January. This is why you don't actually evaluate a real estate market based on month-to-month changes, which is a lot of what the articles out there are doing right now. They're saying, geez, home prices declined from November to December, so that must mean that there's a crash coming. Guess what? Every November to December, it's that way. It's because less people are out looking at homes.
Yeah.
It's because it's snowing in most of the country.
Yeah.
You know, and so this is normal seasonality.
Based on this normal seasonality, does it make sense for somebody who wants to invest in turnkey rentals to wait for this time of year to buy their turnkey rental?
I'm really glad you asked that, because the answer for a turnkey rental is no. What I'm talking about here is macro. I'm talking about the real estate market, and if you wanted to take advantage of this information to be able to buy a property for a lower price, this would be if you're buying a home to live in for yourself, call it the retail market. You can use this information and say, listen, if I go and I try and buy a home, in December, you're probably going to be able to buy it at a lower price than if you try to buy that home the following June. But for turnkey rental properties, it's different, right? Turnkey rental property providers buy properties that produce positive cash flow. And so there's no incentive for them. The properties pay for themselves, like JWB's inventory pays for itself. So there's no incentive for us to sell that property at a discount. Again, when we know that home prices over time are going to continue to go up as you go later on in the year. I mean, that's just home price seasonality. So you got to kind of separate this message. If you're an investor thinking about buying a turnkey property, this doesn't really apply as to how you're going to be able to buy at a discount from a reputable turnkey provider. Yeah. But as an individual homeowner, and you want to go and buy a house, this is certainly applicable for you.
Got it. So homeowner looking for a deal on a home, applicable. Active investor hitting the pavement, looking for distressed properties and trying to acquire it themselves and do this all themselves. Opportunity. Turnkey investor, we need to look at it more as a stabilized depreciation rate over time. That's what you're buying into, because the turnkey provider understands this dynamic and therefore does not give this like distressed income because your inventory makes money for you.
Yeah, exactly. And you don't have and this, if you think about it as well, appraisals are not based on the property selling last month. They're appraised based on the homes that sold over the last 6 months or somewhere around there, because they're trying to remove the elements of seasonality from the appraisal process as well. So hopefully that gives you a little bit more insight there.
Okay. So what I'm hearing is we have a trend that looks like it's dipping a little bit. But you're saying that that's just a temporary dip in seasonality. It's not a overall macro dip that's going to lead to a recession. Why don't you talk us through how you understand this?
Yeah. So again, let's put data and perspective together here. So what I did was I went back and I said, well, geez, have there been any years where home prices from June to January have declined more than 8%? And how did it end given a full 12 months? Did they end up positively? Guess what I found, Pops?
I'm assuming you found something.
Yeah. So I went back to 2013 to 2014, right? Here's the June median home sales price. Here's the following January median home sales price. There was a decline of 18% from June to the following January. Do you remember any articles or any talking heads in 2013, 2014 talking about the next crash coming?
To be honest with you, GC, I was not paying attention to this stuff in 2013, 2014.
Well, I'll tell you what else. None of these other article writers were either, because nobody was talking about that in 2013 and 2014, right? By the next June that happened, over a full 12 months, home prices had appreciated 4.3% in 2013 and 2014. Well, maybe that was just a one-time occurrence, Pablo. I went back and I tried to find another year. And the next year it happened as well. 2014 to 2015, we had a 13% decline from June to January. And by the end of that 12-month cycle, home prices went up 8.2%, almost double the normal home price appreciation rate. And then I think I threw in another example here. Yeah, from 2016 to 2017, right? We had a 12% decline of prices from June to January. And you can see here that over the 12 months, home prices not only made up that decline from seasonality, they appreciated 7.3% over a full year. So hopefully this data of home prices going down mixed with this perspective that home prices go down almost every single year from June to January helps you feel a little bit better about what's actually happening.
Got it. All right. So that's the perspective. That's the different data that allows us to make better decisions. So how much did it decline in this season right now? Have you gotten into that yet?
Yes. So then I went and said, okay, well, what happened from June to January? What are we experiencing right now? Jacksonville home prices have declined 9.1%. All right. 9.1%. Again, on average for the last 20 years, they declined a little over 8%. So the fact that we've declined 9.1%, very normal. We are experiencing normal seasonality in Jacksonville. This is exactly what we've been predicting. And this is why I have been saying this for over a year now, that there will not be a real estate market crash in Jacksonville like we had in 2008. And this data is showing that it's ongoing and proving this thesis.
It's interesting to be here right now in March of 2023. And I remember when you first kind of like started talking about this, I remember it was probably about like October 2022. And you're like, hey man, we got to start talking about the fact that articles are going to start coming out about real estate crashing. Mm-hmm. And what's going to happen is seasonality. And you can go back to our shows during that time, and it's got you talking about that and starting to prep people, and then now seeing it all come full cycle and these numbers hitting right in line with what you're saying. It's amazing to see you say this a lot in real estate, the answers to the test.
Yeah.
Because the data allows you to, mm-hmm. right? Like, so it's really interesting to like watch it happen in real time. And now having been doing this for 3 years and seeing you over and over again, be able to peg this with mother of data flywheel, right? Mm-hmm. And using this data to do it, I just find it surreal, right? So like this idea that the other trend that I see is you generally start kind of like whispering, like, hey man, I don't think there's going to be a crash or anything like that. What should I talk about? And I'm like, well, Greg, you should just say that. And then as the data matures, you're like, there's not going to be a real estate market crash, right? Like You get more and more empathetic as you say this stuff, as the data matures, which I think is another cycle too. If you've been watching the show for a while, or you're going to start watch how I'm obsessed with how you communicate. I think that's no secret, but like seeing that rhythm, I've now started to notice it's like, okay, this is a peek into the future, right? Like you start whispering something, then you start proving the data, and then you start like banging the table about it, and you can hear it on the microphone.
Well, you've helped me with that. I mean, a long time ago, before we did the show, I just kind of like whispered this to myself and I didn't tell anybody. That's right. Or our team would whisper this, of course, and we would talk about it internally. This platform and this show, I think, has brought the best out of our team, right? Because these are the things that how we make decisions with our own resources internally. And there's no difference between how we make decisions and how you can make decisions to put yourself up for financial gain. So I'm excited about it, right? And then the next thing that we should be talking about here is what's the next most important thing that we talk about on the show?
You were just talking about the team and bringing the best out, and the mother of the flywheel, Tara Klein, is asking about, hey, have we talked about MOI yet?
What a perfect segue there.
Perfect segue.
Awesome, Tara. Appreciate you. So months of inventory. Again, if you're new to the show here, months of inventory, Pablo, thank you for saying those nice things about our team and about how we're able to kind of like peg what's going on in the future of real estate. That's due to two things: due to the hard work of our team, right? And the experience, right? And putting this together. But also, this is an asset class that is much easier to understand what's going to happen in the future than other asset classes, right? Part of that is the lack of liquidity here in real estate, right? Saying that another way, everybody talks about how the stock market is so great because it's so liquid. Well, with liquidity means that you got super high highs and you got super low lows and things change often. One of the best things about real estate is that it is not super liquid, which helps us understand exactly what's going to happen, in the short run and in the long run. And one of the best metrics that we have at our disposal is called months of inventory. And what this does is it tracks the number of homes that are on the market, so the supply, and it also tracks the number of homes that sold the previous month. And what it tracks is how many months would it take to exhaust the current inventory on the market. And when we look over time, we're able to see a correlation between months of inventory, which in essence is just supply and demand, and home price appreciation. So we measure this every single month, and then we report on it here and often on the show. And what we've been able to say, especially 2 years ago, when I was whispering to you, hey, home prices are going to go up. Yeah. Why did I tell you home prices were going to go up?
I remember COVID hits, everybody's freaking out because it's an unprecedented thing. And you're like, listen, man, the number one leading indicator to short-term home price appreciation or depreciation is months of inventory. It's this MOI figure that we talk about, and you started whispering about it March 2020.
And then home prices went up 15 to 20% for the next 2 years because what MOI told us. So here's just some simple things to keep in mind here. MOI, if it is higher than 6, that means you have more than 6 months of inventory. That would lead to lower than expected home price appreciation because you got more supply out there than demand, and that would lead to lower than normal home price appreciation. If you have lower than 6 months of inventory, that would mean that you have more demand than supply. So that would actually lead to higher than normal home price appreciation. And the one caveat here is this is in normal markets. This is not the only thing that you need to pay attention to, right? Yeah, obviously we pay attention to a lot more than this, but I'll say the one caveat to this is that we have never had a Federal Reserve in my lifetime, and as long as I've been investing, we've never had a Federal Reserve taking a more aggressive stance on interest rates here. So normally this is the number one indicator. I'm going to say we have to take this within context of what the Fed is doing as well, because that can have a great effect on it. And quite honestly, how the Fed affects MOI, we're still all kind of figuring this out together because the Fed hasn't done what it's done to interest rates in 40 years. But keeping that to the side, this is a great indicator of what home prices are going to do. And so I thought I'd put some data behind it.
Awesome. All right. So let's look at it. Let's get into it. I just want to call out anonymous attendee, just put a great list of concerns in the Q&A. We're going to hit every single one of those once we finish this update, kind of like to finish out this call. So if you got more concerns, you want us to hit deeper on certain topics, please put them in the Q&A. We're going to dive into all of it, and we'll do it as soon as we're done with the presentation.
Fantastic. Appreciate all of your support and questions. That's what makes this thing super fun and super great for everybody. So, but I thought I'd give you the real data here as I do every single quarterly update. So months of inventory 2 years ago, to give you some perspective, we had about 3,500 homes on the market, 2,300 sales. That gets you to a MOI, months of inventory, about 1.5. Is that less than 6?
That's less than 6.
That is about the lowest that we have seen ever. Yep. In Jacksonville. Yep. And that's why 2 years ago, I was saying home prices are going way up, and then they went up, 15 to 20%. 1 year ago, not much had changed. Inventory actually went down, right? Less than 3,000 houses on the market, about 2,300 sales, 1.3 months of inventory. What was I saying home prices were going to do last year?
Go up.
Go up. This is what I was looking at, right? And at that time, the Fed's interest rates, the Fed was saying we're going to keep interest rates low for the and they were continuing to buy mortgage-backed securities and bonds and all this stuff. So that was a no-brainer that home prices were going up when you see all that happening. Yep. Now, let's look at what we got. We got 6,800 homes on the market, about 1,666 sales, 4.1 months of inventory. Pablo, you are not a real estate expert. What do you see when you see this data?
I mean, I see an increasing months of inventory. Based on the last slide, I see that we're still not at the historical average. So I would assume that we would be increasing in home price appreciation higher than 4.6%, but not like gangbusters like it was in February 2022.
Well, and that is good because you are part of the show and then you saw the previous slide.
Correct.
All right. Yeah. Let's say that you're a reporter or an article writer.
Yeah. I'd be like, this is trending in a bad direction.
Yeah. Yeah. Right. You'd say, geez, our inventory levels are, over twice what they were a year ago. This means we have way too much supply out there. 4 months of inventory. It was 1.3 a year ago. What's that? A 3X, increase to MOI. Market crash is coming. Right. Yeah. There's your title. There's your headline. There's your data that lacks perspective. Okay. Let's go into a little bit of perspective here. I went back and I looked at different points in time to see months of inventory at different levels. And what was the home price appreciation over the next 12 months? December 2007, the highest MOI I have ever seen. This is when I started to invest in rental properties. by the way. So all of you who are worried about a worst case scenario, I've lived it. I still own those rental properties. They still outperformed Warren Buffett and the S&P 500, even though the Great Recession happened. A little tidbit there. But 2007, 18 months of inventory. And then over the next 12 months, home prices in Jacksonville depreciated 10%. Is 18 over 6?
18 over 6 is 3.
Well, is 18 more than 6?
Oh, yeah, correct.
We'll work on our routine here together. 18 is more than 6.
Yeah.
And so you would expect lower than normal home price appreciation. The higher you get more than 6, the lower than normal home price appreciation. You might even see depreciation, which is what we saw when we got up to 18. June 2009, we still had 11 months of inventory and home prices dropped about 10% over the following 12 months. But then things started to change, right? October 2014, we had 4.9 months of inventory. October 2016, we had 3.9 months of inventory. And the home price appreciation over the next 12 months was 7 or 8%.
Yep.
Now we're at 4.1 months of inventory right now. That's right in the middle of those, actually closer to 2016. So a little bit of perspective. Let's keep going.
Okay.
Right? October of 2018, before the pandemic, before all of this, we were at 3.9 months of inventory, roughly what we're at right now. We didn't have depreciation. We had appreciation of 5.2%, higher than normal.
Yep.
March 2020, we were at 3.3 months of inventory. Okay, that was the pandemic.
Yeah.
Right? We were at 3.3 months of inventory, and we were all talking about how supply was so low. Right? We had 12% home price appreciation. At that point, October 2021, you can see 1.4 months of inventory. So here's the thing. We're at 4.1 months of inventory in February 2023. I don't know exactly what home prices are going to do over the next 12 months. That has never been harder to predict than it is right now because of one reason, and that's the Fed. But what I do know is that based on data and perspective, this is another strong data point with perspective for you to show you that this is not going to be the crash of 2008. We may have home prices go down slightly. I don't know what the Fed's going to do. If the Fed is not nearly as aggressive of interest rates, I think we could have home prices go up. It's really dependent on them. But what I feel really confident about is that this is not the crash. And I hope that that information helps you make better decisions.
At the end of the day, did you see, a bunch of different numbers, right? Like we have this like standard of if MOI is here, then we know it's going to be like somewhere around historical appreciation, and it's below that, right? So that tells us it's going higher than historical home price appreciation, but you're still not going all the way in on this idea that in the short term, they're going up. I assume that that's coming because of the trend, right? Like, and the Fed going willy-nilly. But what can we safely kind of like expect? You're saying it's not going to be a crash. When you say the difference between it's not going to be a crash, and yet you stop from saying it's definitely going up this year, what's that middle ground? Like, what are you essentially, what is the timeline of what you are expecting things to happen in?
Well, let's kind of put it into numbers, right? And when the crash happened, home prices dropped about 35% in Jacksonville from 2006 to 2010. So that was about a 35% crash, right? I think at the height, home prices dropped about 11% or so in Jacksonville over a one year cycle there. So when I say this is not going to be the crash, you're not going to see a 35% crash in the market here. You simply have an undersupply of housing right now. If it weren't for the Fed having to raise interest rates as much as they are because of inflation, absent of that, I'd be up here saying, hey, listen, I'm expecting normal growth for us next year. But the Fed is that great variable. And so, to put it into like objective, like real numbers, what we think here internally, if we have to talk about what home prices are going to do over the next year, I think there could be a scenario where home prices actually grow. Home prices could go up maybe 5%. I think there's a scenario where home prices could decline over the next year, maybe a max of maybe 10%. So when I'm talking about this not being the crash, I'm saying we're not getting anywhere close to a 35% drop over the next 3 to 4 years. In fact, no matter what home prices do this year, home prices are expected to be higher in 3 years from now. So that would be what the differentiation would be.
So then the question becomes, if I have money right now that is sitting on the sidelines, let's say I got money in savings and I'm wondering whether or not I should put it to work for me right now or keep it in a savings account. What do I need to think through there in kind of that timeline that you gave?
Well, so now you're thinking of just either putting it on the sidelines, call it a savings account, you're not earning any interest on it, or putting it into action in rental properties
or stocks or bonds or whatever.
Well, anytime your job is to find the best risk adjusted return with your dollars, and you have options, always have options, right? I was just looking at some data here. The vast majority of Americans who are investors own stocks. The next most common is bonds, right? Only 7% of investors out there actually own rental properties, according to the IRS, actually, which I thought was some pretty cool data. So let's look at some of those more common alternatives, right? Stock market, it has been a very volatile ride. A lot of people lost a lot of money in the stock market over the last year. But what many people don't realize is that we're not in a recession yet. And when you go into recessions, stock market does not do well in recessions. So now going back to your question, what should I do with this money? Should I invest in the stock market right now? On average, over the last 12 recessions since World War II, the S&P 500 has lost an average of 30%. So if you're saying, well, what should I do with my money? I'm not taking money and I'm putting it into the stock market right now. It's going to be volatile, and history would tell us there's a very significant chance there's going to be a dip forthcoming. Yeah. Now let's go to bonds. Well, bonds, right? They're just not keeping up with inflation. So, if you start to invest in bonds, it's like, well, how much am I really losing? That's the decision you're making. I'm going to lose a little bit less. Yeah. That's what the decision is, because, your yield on a bond is not 6% typically. And right now inflation is a little bit over 6%. So, unless you like going into an investment and saying, how much am I going to lose? Bonds don't really work for people right now as well. The next thing might be keeping it under my mattress. And again, if you're keeping it under your mattress, or I call that keeping it in a savings account, you're losing there too. You're losing more than bonds, right? You're not earning a return, but your spending power is dropping by over 6% a year, because that's what the consumer price index is, which measures inflation. So people are stuck between a rock and a hard place when it comes to an investment. I think people are searching for an alternative that is consistent, that has a high floor, and the unfortunate thing is that people just don't have the data and the perspective when it comes to real estate, because none of this information that I'm sharing with you is proprietary. It's all available out there. But what this should reinforce for you is that for those JWB clients who are investing right now, you're in the right asset class for consistency, for a high floor. Many people don't know this, but US rents have never declined nationally. Even during the Great Recession, never declined. So your rental income is strong. And almost every single year, home prices have gone up in Jacksonville as well. I think it was, I don't want to misquote it. It's a very high percentage of years home prices have gone up since 1982. So you have an asset class here, which is consistent, which has upside. And I think that the strength of this asset class is going to show when people are looking 1 year from today and they're thinking about where they put their money. People are going to be talking. Well, I don't know if the news is going to be writing articles about it, but I'm going to be talking about what a great decision it was because of consistency, high floor, and upside, which you get in rental properties.
You mentioned a couple of things there, right? So like when I think of this like months of inventory stat, I think of what's being built, what's available right now, and people moving to Jacksonville. It still feels from a tangible standpoint, people continue to move to Jacksonville, whether be it from South Florida, which is more expensive, and the other Florida markets that are more expensive, to this lesser expensive market that has as much or more economic opportunity and a bunch of great jobs. I have to assume that plays well for both home price appreciation and both for rents as well, right? Like I hear that's really hard to find a place to rent these days. It is.
And you start to look at the projections of rent prices in Jacksonville, even though rents have gone up, 20-30% over the last, few years here in Jacksonville, which is unbelievably high. I've never seen rents go up that much in a short time period. We're still expecting rent price appreciation in 2023, 2024, 2025. The same challenges to affordability that interest rates are creating is pushing more demand to people renting. So if you are sitting on an asset like rental properties right now, you really are in a position of strength that most investors do not know. They just can't achieve that right now in the stock market and in bonds.
When I hear you say it, I'm putting on my existing investor hat, right? Like I think of the idea that I took money out of the market at the beginning of 2022, put it in a rental property. I locked in the gains that I've had over the last 14 years and preserved that capital. And now that I'm in it, I'm also thinking, okay, I feel like rents are going to continue to go up. So my asset is going to be good. There is going to be low, not a lot of vacancy. I'm going to get rent escalators year after year. It's going to perform well. If I'm thinking about the prospective investor, I'm thinking, okay, well, I have a choice. I have a choice of choosing how much I'm going to lose, right? And how much I mitigate loss. Or do I choose, which is, not doing anything? I think you're just taking the inflation hit. Putting in bonds, you're saying, I'm just going to take a little bit less of a hit. Or I can say, put it in stock market and go for the ride, baby. Like bet it all on black. Or you can say, I'm going to take this money and I'm going to put it in a cash flowing asset that's a rental property that's likely going to retain its value, very, very most likely going to be going up in the next 2 to 3 years. And in the meantime, the thing that keeps it going, which is that like rental demand and the cash flow that allows you to stay in it without suffering, is going to stay stable / go up.
Mm-hmm.
Okay.
Mm-hmm.
All right. Cool, man. So I think that's the, we got one good. I think we're going to hit all these questions here at the end, but I think there is one good one here to talk about. I had it highlighted and I lost it. No big deal. Interest rates. No.
You guys really showed up in the chat
Yeah.
today, and thank you all for being here. I think this is our highest attended show in a long, long time. So look at this.
Here we go. Interest rates rising are intended to slow inflation, but wouldn't inflation increase both the value of homes as well as rental income, assuming wage increases?
Yeah. So what we're talking about here from our friend, Not Your Average Guest, is that typically what we talk about real estate is a hedge against inflation. And so as inflation rises, typically your home prices rise and your rents rise, which over the long haul is absolutely the case. It's one of the 5 profit centers, one of the reasons to invest in rental properties. The thing about it right now is that when inflation rages so high, like it is right now, that the Fed has to step in and raise interest rates to a level and to a degree that they haven't done in 40 years since the last time we had raging inflation. What that can do is that can really shake the demand portion of home prices. And so, in normal times where the Fed is acting normally, your comment is exactly right. Home prices tend to go up with the rate of inflation, and rents do as well. Right now, because inflation is way too high, the Fed is stepping in and saying, we're willing to drive this country into a recession in order to get inflation down. That's the difference between how this would affect home prices depending on the Fed's actions.
Okay, cool. Well, all of this stuff is good and well. These are all numbers of how the real estate market is going to perform. But I think there's another part of this, right? Like if you are investing in real estate, it's really about your operator. So whether you're an active investor or whether you are right now investing with JWB, I think you want to know how well the company's performing, right? There's been a lot of local layoffs in bigger real estate outfits here in Jacksonville. So let's talk a little bit about that. And this is also good breadcrumbs for the local market that's trying to build their own JWB here in your backyard, which I know that you're all for. Come and get it.
100%.
Yeah. So let's get, sorry, I interrupted you there.
Well, no, I think that'd be great. We want more great companies, especially vertically integrated companies here in Jacksonville. And, I think the strength of being a vertically integrated company is in a time where a recession is looming and likely at some point in the future here. There is no talk at JWB about people losing their jobs, right? But in other real estate organizations and tech organizations, we've all heard the hundreds of thousands of layoffs that have been happening. That's a real thing. So I'm really, really happy. But I think our vertically integrated approach is going to show its strength more over the coming years as we most likely are dealing with a recession than even in the past couple of years.
Yeah.
Because we're going to be here. Our team is strong. Our team is not worried about losing their job. We're here to perform for you. And so we're going to start to see some of that in the company update.
Cool. Let's check it out.
So again, we're 2 months into the year here, and I just wanted to show you the stats that we have put up in the different departments within JWB. So properties purchased, new construction, completed renos, and property sales. A couple things to point out here. Let's talk about properties purchased, right? Pablo, we did the show a number of months ago when we revealed JWB's business plan. And in years past, we purchased 700 properties, 800 properties, even 900 properties a year. What do you see when you see 18 properties there?
I see less properties purchased than in the past.
Why do you think that is?
On pace. Well, you have taught me that this is a factory, right? Like JWB's out here producing widgets that produce IRR. And thus far, you have spent a lot of time procuring the raw materials, which is the properties, and you banked a lot of that already. So now you're more in the mode of like the materials in the factory, and you're churning it out based on the actual demand that is happening right now.
Yeah. We have put ourselves in a position of strength when it comes to, call it the raw materials, properties and land that we need to purchase in order to turn these into turnkey assets for you. We have over 3,000 lots in development that we haven't even developed yet. And so when we're sitting down every year and we're saying, okay, where do we need to pull the lever to take a big step forward? I'll tell you, buying properties right now is not high on that list for us. But it's not because we don't believe in this market. It's because we have over 3,000 properties that are going through the pipeline, and it's about right sizing for our business. This is a great year for us to focus on acquiring the right properties for us, right? Making sure that those deals even have higher profit margins for JW. We have the luxury to be able to do that. And so that's what you're seeing as far as properties purchased this year. It's going to be a lot lower than you've seen in past years.
Got it. Our friend Alex Subarats, who came to one of our meetups, he's saying, how is JWB adapting to land acquisition for the changes in the market? Basically, the answer is what you just said, right? Yeah. JWB has proactively adapted to these things by acquiring all this stuff and being in a position of strength right now as this stuff starts happening. Yeah.
I mean, I would not want to be the other side of this, which is not having inventory and having to go and chase inventory in other markets or accept lower profit margins or things like that. So yeah, so that's a little bit on the acquisition side.
Cool. Let's talk about the other KPIs, right? This is the thing that makes it actually all work, right? Rent collection numbers, rent collection at 98.4%, average rent for property at $1,361, current properties under management, 4,925, getting close to that $5,000, that 5,000 figure, DC. I know that that's been a long-term goal. As we go through these numbers, I just kind of want to start with like, why is getting to 5,000 properties under management such a big deal for you all?
Well, for us, what it does is it creates consistency within our entire organization. This vertically integrated approach, we think is great for you and for your investments. But at the core of it, it's great for JWB so that whatever market comes to us, whatever real estate market gets thrown at us, we can just pull a lever a little bit and adapt and thrive. And when you have about 5,000 properties under management, you have a significant source of revenue that comes in that's not dependent on home sales. And actually, as you go into a recession, property management companies and those that have, call it 5,000 properties under management, are in a position of strength. Because if people can't or don't think that they can sell their homes because of a recession, well, then they look to property managers, and it's typically easier to grow your properties under management. So this is what we call a counter-cyclical part of our business, which was a key strategy for us to do many years ago when we opened up our property management to accept, clients who did not buy properties from us.
That decision was made like 2014, right?
Yeah, I think it was a little bit later than 2014. I think it was 2016, 2017.
2016, 2017, 7 years in the making of getting into this counter-cyclical kind of activity, because you have the answers to the test, you eat your own dog food. To me, the other beauty of the properties under management piece is economies of scale, right? Like purchasing power, manpower in your neighborhoods that is able to like handle anything and be out there. I think that is the source of the data flywheel, right? Like if you have the more data points of something similar, the more compounding advantage you have based on data. And I feel like that critical number is huge. The other thing that really sticks out to me, because rent collection to me at 98.4%, that's what you've always had as long as I've been here. That's how it happened during COVID. During COVID. But average rent for property, man, like I feel like when we first started this show, average rent for property was probably closer to about $900 3 years ago. Is that about accurate?
I think it was a little bit more than that, but your point is definitely valid, right? I mean, rents have gone up in our portfolio just like they have in all of Jacksonville, right? And again, this isn't, this is why you invest in this asset class, right? You can win so many different ways. That's why we have these 5 profit centers. And so our clients that have been owning properties for a long time have not only seen home price appreciation, they've seen significant rent price appreciation.
There you go. There you go. All right. So more KPIs here, right? Total houses rented through February 2023. This is new homes that you brought to the market and you put a tenant in,
Yep.
A resident in, 198. Average duration of initial lease, 27.1 months. So still well over the 2-year mark as an average duration of initial lease, meaning that you're getting a bunch of these 3-year leases as well as the 2-year leases. Number of leases re-signed, right? This is the keeping your resident inside the home and avoiding a turn. Renewals, 261. That is how you overpromise, underdeliver on expectations. And eviction percentage of 0.18%, almost negligible.
Yeah. And I just want to give a shout out to our entire team, which goes into supporting why people re-sign their leases, and specifically our property management team. Our property management team just set a world record last week and re-signed 71 leases in a single week. That's 71 properties, 71 clients, give it, that are having thousands of dollars that they do not have to spend when it comes to, lost rent or tenant placement fees or cost, right? These are the things that can make your experience great if you work with a vertically integrated provider who challenges themselves to set world records and re-sign dozens and dozens and even 71 leases in a single week. So that's the type of commitment we have to that.
To me, as an investor, I'm looking at a tough economy where people are making tough housing choices. And I look at these numbers of performance, and this to me is my asset is doing fine, right? Is you guys have like a high performing machine that is able to get butts inside of rooms of houses. And if I'm thinking of this as, well, where do I put my money going forward? I think of, I want to put my money into something where I know that the fundamental piece, the idea of occupancy, like in rental properties, for it to perform, occupancy is the data point.
Mm-hmm.
In the stock market, for it to performing, profitability is the data point.
Right.
Right. Like, am I more certain that companies are going to be able to hit their profitability numbers in uncertain times versus people being able to get into these workforce homes during uncertain times? To me, these numbers are what tell me as an investor, yes, this is safe. This has a high floor and it has likely upside based on everything I'm hearing.
Yep, absolutely.
Okay, cool. I'm glad you agree with me. Makes me feel smart. All right. So the current inventory overview, right? So purchase prices are now somewhere between 180K to 280K. And that feels like it's significantly up from when we started the show.
Definitely from a few years ago, for sure.
And IRRs at 14% plus. That sounds incredibly attractive in a world where, people will do anything for 9%. Mm-hmm. Mix of renovations, new construction still on the market, right? So you can still get new construction. You can still get renos. Properties right now, you're only selling properties finished with the construction by date of close, mm-hmm. which is a change from last year where you could have had like a 6-month waiting period. At this point, you are going into a cash flowing asset because it's finished with construction. You're going to have a resident in there, and 67% of available inventory is already rented. What does that mean? Yeah,
and I wanted to give everybody an overview for those who are thinking about adding to their portfolio now or really over the coming, months and quarter. What you may have not seen, but what we have been doing behind the scenes is building out a lot of inventory, making sure we have a runway for you all, and then working our very best to slowly increase that percentage of inventory that's rented at the time that you put it under contract. And so and this is a part of this experience that we want you to have, right? It's great if a home is rented when you put it under contract. It's okay if it's not. That's normal that it's not. But if we can, work this inventory through our process and have a high percentage of it being already rented, well, this is a great time for you to take advantage of that. This is what we've been working towards internally to improve the experience. And so that's kind of where we are right now. 2/3 of the available inventory is already rented, cash flow positive from day one. And again, a great way to walk into your next rental property.
Cool. And we're about to get into the Q&A section of it. Great concerns in the chat. So Derek, anonymous attendee, Marie, Lee, Ken, we're going to get into your questions right now. Mike Foster, Chris Gonzaga. But I think we would be remiss not to talk about the incentive that's still in place for a limited time, $10,000 in incentives through the end of March. GC, you want to explain this stuff?
Yeah. And this is really critical. We're getting into, it's already March 7th here, and this incentive is going to end on March 31st. This is the largest incentive package that we have ever offered at JWB. And many of you on the call here have taken advantage of it. And I think it's really something to pay attention to. When we talk about how we get to 14% plus IRRs, that's assuming you take advantage of these incentives. Mm-hmm. The IRRs would not be that high if this incentive was not there. This assumes that your interest rate is going to be at 5.5% around there. And that's because JWB uses this incentives to buy down your interest rate for you. So a much better time for you to be purchasing right now due to this incentive. And it's going away in a few weeks here. So it's about $10,000. The way that that's broken down is JWB is paying 2% of seller concessions, which comes out to about a $5,500 value of cash you just don't need to bring to the closing table. JWB covers that for you. JWB is waiving our first tenant placement fee, which is worth about $1,500. And then JWB is paying the first $3,000 of costs. You can call this a cash flow credit. Most of the time, clients are using this towards your maintenance costs. And so the first $3,000 of maintenance costs that come during your ownership, no expiration time on it, that first $3,000 is going to be on JWB's dime. A fantastic way to walk into your first or, maybe your third or fifth or 10th rental property with us.
There you go. We landed this under an hour, man, without the Q&A. Good stuff.
There you go.
If this is your first time, right? We normally don't have 111 people on the call. We normally have between 50 to 60, right? So if this is your first time joining, this is what we do every week, right? For an hour, we go into data and insights and perspective and all the good things that you want. So we hope that you make a habit out of joining us here on Tuesdays and Thursdays. Just want to do that in case anybody needs to get off, but go to nyais.com. If you register for this call, I assume you're already registered for the other ones.
Yes.
So you're going to get some updates. You're going to know that, what the topic is. If it's worth your while, come on down. The more you come, the more you make friends with people in the chat. That's just kind of how it works. We got a real community here that is bolstered by some really, really savvy real estate investors that have made great relationships that continue on and offline. And yeah, let's get into the Q&A, shall we? So first Q for your A by Chris Gonzaga from the illustrious Hudson Valley of New York. TPP form for appraiser, is that required for long-term rentals in Jacksonville? St. Johns County hit me up for this form for the first time this year.
I feel like I should know what the TPP form is, but all I can think of is that TP reports from TPS reports?
Yeah, we're going to need the TPP form.
I feel like I should know that, Chris. I'm sorry. It's just not
personal property. Chris is saying personal property.
Personal property form. Chris, I don't know the answer to that question.
Personal property.
Tangible personal property. I don't know the answer to that question, but this is a great time to make sure that everybody knows for questions that are specific to your portfolio, or if you're new and you want to start the journey of investing with JWB, reach out to our team. If you're a current client, you already have your portfolio manager, just fire them an email or pick up the phone, give them a call. I know we can help you with that, because that's the beauty of the team. I don't know the answer, but I'm one phone call away, and so are you.
There you go. Mike Foster has got a question. Do you have a similar 2006 to present trend chart specifically for JWB properties?
I don't have one handy, but I can certainly put that together. You know what, Mike? This is part of the beauty of this show too. I'll take your feedback and then I'll put something together and I'll show it maybe on like a Thursday show or maybe on a future Tuesday show. Yeah. We'll put that together there.
Sounds good. All right, Mike, we're gonna include that into the show. We know that you show up, so we'll definitely make that happen for you, buddy. Lee, the MVP of the community, Bishop, has a question. So the first half saw a decline in those years. Does that mean for overall to get to positive home price appreciation rates that the last half of the year has to be double digits, right?
Nailed it, Mr. MVP. So this happens every single year as far as its decline from June to January. But guess what happens from January to June? Goes up. Goes up. So that's what you're going to start to see. I'm really interested to see what the headlines are and the articles are when you have the opposite effect of seasonality, which is in the spring, months and getting into summer, as people are out and about and there's more demand for housing, that home prices go up generally. So it'll be interesting to see how they write about that. But your point is 100% right. You see the opposite effect from January to June.
Got it. All right. This one's meaty, GC. We have an anonymous attendee asking in what their concerns are. I'm going to just say them all and then we're going to go one by one and you can speak to them.
Okay.
Concerns: real estate market outlook over the next several years. Property turns taking longer. Did I buy it in the right neighborhood? looking for ways to capitalize on the equity increases in the homeowner insurance rates and taxes outpacing rental rate increases. And I'm sure I can think of several more. Anonymous, just so you know, you just set out the agenda for Q3 of the show. We're gonna do every single one of these as a show. But for right now, GC, let's start with real estate market outlook over the next several years. If I heard you correctly, you believe that over the next several years, the outlook is positive, right? Over the next 2 to 3 years, prices are going to be higher than they are today. What you have also said is in the really, really short run, in the next maybe year and a half, 2 years, there may be a small dip, but you are very confident that in the next 2 to 3 years, it's going to be higher than today. And on top of that, fairly confident that it's going to outperform other asset classes that you're looking at in the same short run.
Yeah. And I'm not the only one who thinks that, call it over the next 3 years, that home prices are going to be higher than what they are today. I'm not the only one. You can go across the board to other experts. And, this undersupply that we face ourselves in is a driving force of why home prices are going to be more consistent than other asset classes, and why over time home prices are going to, go up. So what I would say is over the next 1 to 2 years, I don't know, because I don't know what the Fed's going to do. If the Fed was out of here, I'd take a much stronger stance on what home prices are going to do over the next 1 to 2 years. Yeah. I think that they're going to be a lot more consistent than other places that you're thinking about putting your money. And these are one of the only places that I see you having the chance to beat inflation over the next 1 to 2 years. But I think if we go a little bit farther than that, you shouldn't be investing in rental properties if you have a 1 or 2 year horizon. That's why I think short-term pricing, even though it tends to generate a lot of headlines and we talk about it here, it is the least most important part of this equation for you to invest in a rental property, because it's all about the long run, right? In the long run, this asset class wins because it has all 5 profit centers. In the short run, like if the Fed jacks up interest rates another 4 points over the next year, sure, that's going to bring home prices down. I mean, I don't expect that to happen, but over time, over a full market cycle, even if they did that, I would expect that home prices would revert back to their historical norms, which is the same thing that has happened given 10 to 20 year cycles all the way back from 1982. So I don't know exactly what home prices are going to do over the next year because of the Fed, but I also think it doesn't matter if you're investing for the right reasons in rental properties.
Next concern, property turns taking longer.
Well, property turns are taking longer because everything last year was not normal. A year ago, homes for rent and homes for sale were at all-time lows. Like anything you put on the market was rented pretty much that day. And so, it's all relative. You're 100% right that property turns are taking longer, but that's because they were artificially low. And we talked about that being, that way on the show. Very normal right now. This is normal. This is all built into your return expectations. We have maintenance and vacancy expectations that take historical norms for costs, not just what happened last year. So our evaluations are built to account for the fact that property turns are longer than they were last year, but right about where they should be.
Got it. Did I buy in the right neighborhood? Concern number 3.
That's always a great concern. The right neighborhood is defined as those workforce housing neighborhoods. And the reason that you want to be there is because you want to buy in an area where there's low prices, high rents, and surrounded by jobs. So JWB, we have 4 core neighborhoods. I'm not sure if you're a current client or a prospective, probably sound like more of a prospective client, would certainly encourage you to jump on the phone with our team and we can talk through why we put you in those 4 neighborhoods, which is where I've been investing my own money since 2006.
I know you don't like me saying this, GC. You nervous?
Nah. No, you don't make me nervous anymore.
But one of the things that I find fascinating about the economies of scales that you have reached, right? Like sharp real estate investors know to look for people that have better data than everybody else. And when they make a move, people pile on. Mm-hmm. Here in the Southeast, we've got a shopping center brand called Publix. Beloved, right? Amazing chicken fingers and subs.
True.
And sharp real estate investors know that, they're looking for where Publix is putting a store in, because they realize that Publix has better data than everybody else. And when Publix sets up a store, everybody knows that those property values are going to rise. I think people do that with Starbucks, Whole Foods, whatever. What I find fascinating is that JWB here locally has become one of those signals. You hear it in the local networking rooms. Hey man, where's JWB going? Right? Like people talk to me like I know anything. And they're like, what are they doing? Where are they going next? They try to get that info because they know that where JWB is investing, it starts to become self-fulfilling prophecy to a certain extent. And I think that part of it, whether the, we showed on a recent show that JWB properties have appreciated like 70% more than the average than the average property in Jacksonville. Whether that is because these guys are smarter than everybody else, or at some point people just started piling on to the self-fulfilling prophecy of it all. I think that's a real thing to talk about. You don't like to call yourself a market maker, but at some point you have to accept the fact that you are a market leader and you have better data than 99% of everybody else. So there is a little bit of this like effect that where you plant the flag, other people follow, and that is some risk mitigation.
I mean, there's a reason why people want to invest with Warren Buffett, right? Warren Buffett is not a market maker, but Warren Buffett, it's the reason why Berkshire Hathaway is the most expensive stock in the world. Everybody wants to be a part of what Warren Buffett does. I'm certainly not going to say that we're at that level, but there's elements of that, right? Part of this though, is because we have our own money in these same neighborhoods. We have a huge incentive to make these neighborhoods work. That's why we do so much more than just do great property management, right? We work with the city to make sure that zoning and streets and neighborhoods are built correctly so that, there's the right amenities for those in the neighborhoods. We work from a community service perspective. We volunteer in these neighborhoods. We build new homes. We give them away to veterans in our neighborhoods. We work with influential business leaders and social leaders in these neighborhoods to make sure that we are welcome here and that we are revitalizing these neighborhoods the right way. And so why do we do that? It's because we want to perform for you. But I think it's important for you to know that we have over 300 rental properties in those same neighborhoods. Mm-hmm. So we have a huge incentive. And that's one of the reasons why, our clients have seen 79% more home price appreciation.
79%.
79%.
My bad.
You're like, you got the point every single time. You're like 1 decimal point off. Yeah. I love you for it, dude.
Yeah.
But that's right. 79% more home price appreciation for JWB clients since 2013. It's a part of all of that together is a part of why this thing works.
We have Not Your Average Guest. So if you checked in from your phone, answering to a text message, you automatically opt in as Not Your Average Guest, asking something. It sounds like it's about the incentive. If property is already rented when purchased, will the first tenant placement fee apply in 2 to 3 years when the property is turned?
It's a great question. And at the core, you're asking, will you receive the tenant placement fee incentive, even if the home is already rented? Mm-hmm. And the answer is yes. For every home that we sell to you as a client, if it's rented right off the bat, you get charged a tenant placement fee under normal circumstances. If it's not rented right off the bat, it takes, 15 or 30 days to rent it, you would get charged that tenant placement fee at that point in time. So if you're able to purchase this home, put it under contract by the end of March, that initial tenant placement fee will be waived.
Got it. All right. More concerns from anonymous attendee. One of the I think fourth concern, looking for ways to capitalize on the equity increase. How is that a concern?
Looking for ways to capitalize on the equity increase. This is a great question. In fact, we just did a show on it last week, I believe, talking about ways to utilize the equity that you have built up as a tool to help you accomplish your financial goals. So JWB clients have significant equity in the homes that they own, especially those who have owned it for over 5 years. You're able to leverage that equity in ways to be able to acquire additional assets. You're able to acquire additional rental properties. You're able to do additional private lending. So, this is a concept I teach a lot, right? Equity is nice, but what most people do with equity is they just sit on it. And if you think about it, the fact that it's really hard to accomplish financial independence and your financial goals, equity is a tool. And it needs to be used in a smart way, in a risk mitigated way. But if you're just sitting on it, your return on equity is zero. There are ways for you to leverage that. And again, talk to my team, go back to a prior show. We just did one here. Keep showing up on the show, keep asking the questions. I'm happy to go more into that, but leveraging your equity is a huge opportunity for you.
Yeah, that's one of the things that I find most attractive about this asset class is the idea that you keep getting this equity and you keep being able to use that equity to invest in other things while still gaining from that equity.
Sure.
really unique. Increases in the homeowner insurance rates and taxes outpacing rental rate increases. That's another concern that they list.
Well, homeowner insurance rates for renovated homes have gone up over past years. Has been a common topic for clients and on the show here. It affects renovated homes, doesn't affect new construction homes. So you're able to see new construction homes with still very low insurance rates. And the good news when it comes to those homeowner insurance rate increases is that the legislature in the state of Florida is on it. And there's a special session held. Talked to our insurance teammate, the Ritchie Insurance Group, Whitney Ritchie over there, and she felt very confident that we have stopped the bleeding of the insurance market, stopped some of the loopholes that a lot of lawsuits were being and claims were being filed under. And we expect that market to stabilize. And we hope that in the future, rates should come down for renovated homes. But to your point about rental rates going up, they've gone up significantly. So, I don't think that they have outpaced rental rates. And the thing about rental rates is they keep going up over time, whereas insurance rates, even though they've spiked for renovated homes, no reason they can't come down, and certainly not needing to go up past that.
True. All right. That was one question with like 5.
That was awesome.
In them. That was awesome. Really good stuff. Anonymous attendee. Then we got 7 more. Let's jam, GC.
Sweet.
Ken Moline, patriarch of the first family, says, Greg, do you have any data that compares Fed activity during the Carter recession in the 1970s to Fed activity over the past year?
Yeah, I just, I don't know about the early 70s, but by the end of the 70s, the Fed increased interest rates at a similar pace here. I mean, even more, right? So the data that I know is that this interest rate increase by the Fed at from the middle to the end of 2022 was the fastest rise of increase of interest rates in 4 decades. And so that takes us to the end of the 70s, early 80s. And then interest rates went way higher than where we are in the end of the 70s, early 80s. So I can put some data behind it because I think that would be pretty cool to share. But
that would be interesting.
The Fed back there, Paul Volcker, was not afraid to drive the country into a recession. He raised interest rates, get inflation under control. And, we're not expecting that level of inflation or that level of interest rate hike. But that is what a lot of people are looking at as a case study for what we had to do last time to get inflation under control.
Okay, there you go. History GC. Anonymous attendee has another question. What is the most drastic MOI change you have seen in 1 quarter?
Just making a note here for Ken, because I don't want to forget that. The drastic MOI change you have seen in 1 quarter. I mean, it has been really between, call it, 3 to 6 months of inventory ever since 2014, since we started tracking it monthly. Yeah. It really hasn't changed in a month. It does have some seasonality to it, and then it dropped down to 1. It actually went below 1.
I feel like those big drops that happened in like 2021, 2022 were pretty drastic in comparison to anything else I've seen.
Yeah, definitely dropped, to a really low level. I can write that one down too and give you some real data on it.
Cool. Am I thinking about this wrong in the sense that it is easier for MOI to spike down than up, right? Like, isn't there gonna be like a standard kind of like how much stuff is being built and how many, like a mass exodus to a city is less likely than a mass migration from stuff that we're seeing, or
nope. No, that's what you've only seen.
That's
so
what I've
far.
Seen, yeah.
But think about this, right? People bought a ton of land, a year ago with interest rates being so low. Builders, tens of billions of dollars were rushing into the space. You had Wall Street partnering with home builders for the first time, taking down land and building out houses.
Yeah.
You can have MOI increase a lot if your number of homes that are built, number of communities that are coming online, all hit at the same time. So it can go up and it can also go down quickly, but it is mitigated. The supply side is mitigated by the demand side. So if you've got a lot of people moving to Jacksonville, and you got a whole bunch of houses that are built, then that would limit the drastic change of it.
Okay. All right. Marie's got a question here. She's asking, is there an excess supply of rental properties in Jacksonville right now? The property that she closed on February 2nd is still not rented, and she obviously has some concerns.
Marie, thanks so much for sharing that concern. There is not an excess supply of rental properties in Jacksonville. Now, there's a little bit of seasonality when it comes to the rental market as well. This is something we've been doing for over a decade, so we know this happens. The best time to actually rent your home is what we're coming into, which is called tax season, because there's more money in the economy, especially renters get their tax returns back. They have a little bit more disposable income. That helps. So that happens every single year. But no, nothing to be concerned about as far as an excess supply of rental properties. In fact, the opposite is still true. And that's one reason why we expect rent prices to rise in 2023. It's because we still don't have enough supply to satisfy the total demand for rental properties.
All right. Lee Bishop has a comment here in the Q&A. When I bought my houses, they were about $155K. Now they are worth about $220K. Even if the price drops 10% in value, I am still ahead of the game as far as valuation. My rent is still goes up, and the cost of the home stays steady. I'm in it for the long run. All right. Not a question, but.
And MVB comment there. And, I think the most important thing there is that no matter if the home price went up another 10% or the home price went down 10%, I'm assuming the MVP would say the same thing. I'm in for the long run.
Yeah.
Like that's why short-term pricing is the least most important part of this equation. Yeah. That's why in 2006, when I started to invest in rental properties, the fact that home prices dropped over the next 3-4 years didn't affect me because I wasn't going to sell it anyways. And I still own it. And so, if you do have a long-term outlook on this asset class, things like what the Fed are doing for interest rates right now for the assets that you already own, honestly, don't even matter over the long run. It's still going to get back to that normal historical home price appreciation rate.
Local real estate guy here, Glenn Friedman, says houses don't care how much they are worth. It's a cash flow game, right? That's what we talk about. If we got positive cash flow, you're in it for the long haul.
There you go, Glenn. Great comment.
Derek Nelson asks, what percentage of properties under management, I figured it out, that PUM is properties under management, you see.
Love that.
Properties under management is in the Jacksonville Metro.
What percentage of properties under management is in the Jacksonville Metro? Percentage of properties under management?
I assume it's 100%. Like all your properties under management are in the Jacksonville Metro.
Talking about art. Okay. I thought he was talking a little bit more macro there. Yes, we are all in Jacksonville and surrounding areas, generally about 45 minutes from downtown Jackson or from our office is where we want to be to make sure that we can service those properties appropriately. And so we're focused 100% on Jacksonville.
Anonymous Attendee has another question. Days to get a lease. How is it trending?
It's historically about 40 days is the average. I think we're probably a little bit north of that right now. And so, but if we put it in context, a year ago, it was like 15 days.
4 days.
Yeah. I mean, it was so low. So we need to have some perspective here. So the fact that we're probably a little bit over 40 days right now, again, very normal, especially going into tax season.
All right. Shannon Baker, Touch Maker, is putting in 64 days currently.
There we go. Okay. Glad we got good information there.
That answers Not Your Average Guest puts in what's the typical time to rent a JWB property. So that we're good there. Lee Bishop with another one. Eviction number at 0.18% does not really say anything about the overall eviction process. Are there 100 tenants that are late paying and 0.18 are evicted? Can you go over that a little bit? Because that is not usually a topic on this platform.
Yeah. So that 0.18% is saying that 0.18% of evictions happen each month. So if you had 100 active leases each month, then what's ever 0.18 of 100? What's the math there? So 1.8? No, 0.18. So it's, I don't know what 100 is. Yeah.
Would be
less than 1.
0.18.
0.18? Yeah, there we go. That's it. There we go. Yeah. Oh man, I do math for a living, guys. There we go. So a lot less than 1. So that's just saying that if you only had 100 tenants, that's what that would be. That does not mean that that's the only late payers. There are other late payers that happen, and we work through that entire process to make sure that we get the payments on time, so that we bring them up to full payment and hopefully avoid that eviction process. And then sometimes we're not able to do that. And most property management companies give up and they say, well, we're just going to go forward with eviction. Even if we have to file the eviction, we keep working hard because about 50% of our evictions actually get paid back in full through a stipulation agreement, which is something else we can go in more detail. So not exactly just saying that there's 100 people that are late. There's more than that. I can guarantee you that. But that's where the hard work and the experience comes in of our team.
There you go. Yeah, percent means per 100. So Miguel Angel Sanudo, my friend from Spain, says, are you aware of the report of the Consumer Financial Protection Bureau the Consumer Protection Bureau and Realty Track about Florida cities that could be headed for a housing crisis based on percentage of mortgages that are between 30 to 90 plus days delinquent and homeowner and renter vacancy rates. Jax is the 5th city in Florida under foreseeable housing crisis, according to this.
I would love to read that, Miguel Angel. I think it'd be great to, if you could send that or put that into the Facebook group, that would be awesome. But I can tell you that I am not worried about a foreclosure crisis. So the fact that they're basing this off of the number of, mortgages that are between 30 and 90 days delinquent, we are sitting on incredible amounts of equity because home prices have increased so much over the last 2 years. So if you're somebody who can't afford to make the payments right now because you lost your job, you have such an incentive to sell your house. Like you can sell your house and make money before you get kicked out of it and then save your credit. And so I am not concerned about a foreclosure crisis at all. I think it'd be great for me to read that article because I can be more informed. But I'll tell you what, I'm not concerned about that at all. And I am not concerned about a housing crisis.
Miguel Angel, I just put that in our list of articles to look up so we can do a Not Your Average Insights on it. Walt Hart has a question. Are there advantages to setting up an LLC prior to purchasing rental properties as opposed to privately purchasing / owning the properties?
Walt, that's a great question. I would encourage you to reach out to our team because we can walk you through the pros and cons. Some clients do purchase properties in an LLC, and so we help you and connect you with the right people to set that up for you ahead of time. Other clients choose not to, and that's certainly okay as well. There's pros and cons to both. So just reach out to our team. Let's get a call set up and we can walk you through that process.
Got it. And Not Your Average Guest with a final question here. Does it count as an eviction on your tracker if the renter enters an eviction stipulation after filing?
Does it count as an eviction on your tracker if they enter a stipulation afterwards? I'm sorry, I didn't read the end of it there. If there enters a stipulation after the filing, what I'm reporting to you all are completed evictions. So if somebody has an eviction filed on them, and then they pay it all off through the stipulation agreement, that would not factor into that 0.18%. So answer your question is, it is factored in, and it's because I only show you the completed evictions.
Got it. And then anonymous attendee is asking, can we have a show on LLC versus not in the future? I think the answer to that is we can definitely talk about it on the show. I don't know if that's a full show, right? Like that's one of those things that we can talk through in about 10, 15 minutes. So anonymous, let us know what show of the week you come in, or if you come on a property of the week, we can spend a solid 5 to 10 minutes discussing it and go back and forth. Those are the Thursday shows, or Tuesday, Not Your Average Insights. You can bring it up and we can go deep in it. All right, GC, an hour, 26 minutes. We still have 76 people on the call. We have a world record of 111 folks that showed up today.
Thanks, dude.
Yeah, really, really awesome. Great questions from all of you. Let us know if this satisfied you. Did this scratch your itch of knowing what the Q1 Jacksonville market update looks like? Did it calm your anxieties? Did it give you the information that you need to make smart decisions? Let us know in the Facebook group. Shoot us an email. We love to get this feedback. Anything else that is bothering you, that is keeping you up at night, that is making you curious, please send us emails. I highly encourage you, please, 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 if you've been here, go to Not Your Average Investor Show on your favorite podcast platform or YouTube and subscribe and leave us a review. That really, really helps us out on these days. If you like this and keep coming back, we're going to keep bringing insights. One of our good friends, Tim Horvath, told us that he wasn't aware that we were talking about more than just rental properties on the show. And then the last couple of quarters, we've really opened up the umbrella to talk about macro trends and business investing and all these other things that people are really, really liking. So if this is your first time back in a while, I encourage you to start checking in on some of the stuff that we're doing because it's way better than it was a year ago. Just saying.
There we go. I just want to say thank you to you all. I mean, the simple fact that hundreds of you took time out of your day to spend with us to learn about this asset, whether you're already investing or whether you're just thinking about it, is incredible. We have an incredible community. If this is your first time joining us, for many of us, I hope you stick around. I just hear over and over again how this community is improving the lives of people that are a part of this community. And we have, call it 50 or 60 or 70 that show up every single week. And so I really hope that you all continue to show up, become, a friend to folks in this community, because we all have open arms, and it's a really wonderful place to be. So Thank you all. Thank you all for clients for being here. Thank you to the JWB team for being here as well and providing such great answers to the questions that I don't know. Thank you to Pablo for teaching me how to multiply times 100 and divide by 100. I don't know what's going on.
Work in progress. Hope to see you on a future show. And just remember, whatever you're doing in this economy, if you were going to get ahead, you just can't think like an average investor. See you on the next one.
See you.